The regulatory framework and conceptual framework of accounting. Section 2. Conceptual framework of accounting 1. By the end of this session, you should be able to define the conceptual framework of accounting, state the purpose of the conceptual framework of accounting, describe the content of the conceptual framework of accounting with regards to the objective of financial reporting, qualitative characteristics of useful financial information, the financial statement and reporting entity, and the element of the financial statement. What is the conceptual framework? The International Accounting Standards Board, that is the IASB or the board, issued the revised conceptual framework for financial reporting. The revised conceptual framework on 29 March 2018. The revised version includes comprehensive changes to the previous conceptual framework issued in 1989 and partly revised in 2010. The previous conceptual framework, that is the 2010 conceptual framework, was criticized for its lack of clarity, the exclusion of certain important concepts, and for being outdated in terms of the IASB's current thinking. The revised conceptual framework came into force from 1st January 2020. The conceptual framework for financial reporting describes the objective of and the concept for general purpose financial reporting. The IASB conceptual framework is not a standard. It does not override the specific requirement of any standard. It sets out the concept which underline the preparation and presentation of financial information for external users. Purpose of the conceptual framework. 1. Assist the International Accounting Standards Board to develop IFRS standards that are based on consistent concepts. 2. Assist preparers to develop consistent accounting policies when no standard applies to a particular transaction or other event, or when a standard allows a choice of accounting policy. 3. Assist all parties to understand and interpret the standards. 4. Contribute to transparency by enhancing the international comparability and quality of financial information, enabling investors and other market participants to make informed economic decisions. 5. Strengthen accountability by reducing the information gap between the providers of capital and the people to whom they have entrusted their money. 6. Contribute to economic efficiency by helping investors to identify opportunities and risks across the world, thus improving capital allocation. Content of the conceptual framework. The framework contains the following issues. 1. The objective of financial reporting. 2. Qualitative characteristics of useful financial information. 3. The financial statement and the reporting entity. 4. The element of financial statements. 5. Recognition and derecognition. 6. Measurement. And 7. Presentation and disclosure. The objective of financial reporting. The objective of general purpose financial reporting is to provide financial information about the financial position, performance, and changes in financial position of a reporting entity that is useful to a wide range of users in making decisions. General purpose financial report provides information about economic resources and claims, and this information we can gather from the statement of financial position. 2. Changes in economic resources and claims, and this is described in the statement of profit or loss and other comprehensive income. 3. Financial performance reflected by past cash flows from the statement of cash flow. And 4. Changes in economic resources and claims not resulting from financial performance, and that is described in the statement of changes in equity. Financial statement and reporting entity. What is a financial statement? Financial statement provides information about economic resources of the reporting entity, claims against the entity, and changes in those resources and claims that meet the definitions of the element of financial statements. The objective of financial statement is to provide financial information about the reporting entity's assets, liabilities, equity, income, and expenses that is useful to users of financial statements in assessing the prospect for future net cash inflows into the reporting entity and in assessing management's stewardship of the entity's economic resources. A complete set of financial statements comprise a statement of financial position as at the end of the reporting period, a statement of profit or loss and other comprehensive income for the reporting period, a statement of changes in equity for the reporting period, a statement of cash flows for the reporting period, a note comprising a summary of significant policies and other explanatory notes, statement of profit or loss and other comprehensive income. This statement provides information about the performance of the entity over a period of time. It matches revenue and gains with expenses and losses to arrive at the net profit or loss. Its preparation is based on the double entry system and is similar to trading profit and loss account. It was previously known as the income statement and now renamed as Statement of Profit or Loss and Other Comprehensive Income. Statement of Financial Position. It provides a list of assets, liabilities, and capital of the entity at a particular point in time. It shows the financial position of the business entity at a point in time. A pictorial presentation of the accounting equation is provided by the statement of financial position in that asset is equated to capital and liabilities. It implies total asset must agree with total of capital and liabilities and can be presented in different forms such as total assets, net assets, and net current assets. It's not prepared based on the double entry but affected by the double entry principle. Statement of cash flows. It shows principal sources and uses of cash in the business. It shows the relationship between profit and cash. It's prepared to show the cash generating potential of the entity. It reports cash flows emanating from operating activities, investing activities, and financing activities. It shows the composition of cash and cash equivalents. Elements of the financial statement. The elements of financial statements defined in the conceptual framework are assets, liabilities, and equity, which relate to the reporting entity's financial position. That is, the assets, liabilities, and equity balances are used in the preparation of the statement of financial position. Income and expenses also relate to reporting entities' financial performance, which means that the income and expenses constitute the elements that are used in the preparation of financial statement of profit or loss and other comprehensive income. Those elements are linked to the economic resources, claims, and changes in economic resources and claims. Assets. An asset is a present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefit. Composition of assets. Assets can be classified into non-current assets, which was previously known as fixed assets, and current assets. Non-current assets are acquired for use in the business and not for resale. The benefit to derive span more than one accounting period, and the cost of acquisition is substantial and significant. Examples of non-current assets include property, plant, and equipment, which are made up of buildings, vehicles, motor van, furniture and fittings, goodwill. These are all classified as non-current assets. Current assets are acquired for resale or to be converted into cash. The benefit spans within one accounting period. Examples of current assets include inventory or stock, receivables or debtors, prepaid expenses, cash, bank balances all constitute current assets. Liability. A liability is a present obligation of the entity to transfer an economic resource as a result of past events. Liabilities can be classified into current and non-current liabilities. Non-current liabilities or long-term liabilities are obligations which must be settled beyond one accounting period. Examples of non-current liabilities include long-term loan, mortgage, debentures, leases are all classified into as non-current liabilities. Current liabilities are obligations which fall due within one accounting period. Examples include accruals, creditors, trade payables, owings, and other obligations that are due within one accounting period. Equity interest or capital. The residual is the residual interest in the asset of the entity after deducting all its liabilities. It is also the internal claims against the resources controlled by the business. It represents the interest of the shareholders and is simply computed as assets minus liabilities. It is also termed shareholders' fund. Income, revenue or gains. Income is increases in assets or decreases in liabilities that result in increases in equity other than those relating to contributions from holders of equity claims. They can be in the form of revenue, that is, inflows from sale of main activity, or gains, inflows from activities incidental to major activities. Examples of revenue is sale of goods or the sales that are made from the sale of goods. And gains, examples of gains is profit from the sale of non-current assets in a merchandising firm. Expenses. Expenses are decreases in assets or increases in liabilities that result in decreases in equity other than those relating to distributions to holders of equity claims. Expenses leads to outflow of an entity's resources. When expenses incurred are not settled, they become liabilities. When cost expires, it becomes expenses. So expenses is the expired cost. So the unexpired portion of cost incurred and paid for is treated as an asset. Examples of expenses include salaries of employees, purchase of goods for resale, payment of rent, payment of wages, payment of insurance. These are all examples of expenses. Expenses result from main operations, whilst losses are from activities incidental to the main operations. In this session, we discussed the definition of the conceptual framework of accounting, the purpose of the conceptual framework of accounting, and we also discussed some of the content of the conceptual framework of accounting, namely the objective of financial reporting, the qualitative characteristics of useful financial information, the financial statement and reporting entity, and the element of financial statements. Thank you.